Welcome back to the Deep Dive. This is the show where we grab those really complex topics, sometimes ones you'd rather maybe ignore, and we try to boil them down, make them clear, maybe even a little bit fun. Today, we're definitely diving headfirst into one of those areas. It often feels like wading through fog, but it's super important, especially if you're a high earner. We're talking about the additional Medicare tax, and specifically that form that goes with it, Form 8959. Sounds thrilling, right?
Well, maybe not thrilling, but definitely important.
Right. So our mission today isn't just, a quick flyby. We're going deep. We want to give you that practical, usable knowledge. Who does this tax actually hit? How do they figure it out? And maybe the most important part, how can you make sure you're handling it right? Managing things proactively. Think of this as your shortcut, not just to info, but to actually getting it. Maybe save yourself some headaches, or hey, maybe you can get some money back if too much was withheld. That's possible too.
Absolutely. Taxes, they can feel like a maze sometimes, can't they? But really understanding the specifics, the nuances of something like the additional Medicare tax, it's just key. It's really more than just, ticking a box for compliance. It's smart financial planning, making sure there are no nasty surprises, no penalties, and really crucially, making sure you're only paying what you actually owe. So yeah, we're here to shine a bright light on this sometimes confusing corner of the tax world.
Okay, let's do it. Let's unpack this right from the very beginning. What is this additional Medicare tax? Is it just, more Medicare tax, like the name says, or is it fundamentally different from the regular Medicare tax we all kind of see on our pay stubs?
That's a really good place to start because, yeah, it says additional, but it works differently than the standard Medicare tax. The additional Medicare tax, it's a 0.9% surtax, and it only applies to certain kinds of income once that income goes over specific threshold amounts. Its main job, from the IRS's point of view, is really two things. First, figure out exactly how much of this additional Medicare tax you owe for the year. And second, to square that up with any amount your employer might have already taken out, already withheld, it's about balancing the books at tax time.
Balancing the books, okay.
And it's really important to note, Form 8959, it doesn't just float out there on its own. It's an attachment. It has to go with your main tax return. So that's usually Form 1040, right? Or Form 1040 SR for seniors. Could also be Form 1040 NR if you're a non-resident alien. Or Form 1040 SS. The bottom line is, if you need to file Form 8959, you absolutely must file one of those main returns too. It's not like a separate thing you send in by itself.
Got it. Okay. So it rides along with your main return. Now, what kind of income are we talking about? Does this 0.9% hit everything? Or is it just specific stuff?
No, it's definitely specific. And this is where, the details really matter. This 0.9% tax, it mainly hits three types of income. First, your Medicare wages. That's usually the number you see in box 5 of your W-2. Second, there's Railroad Retirement Tax Act compensation, RRTA compensation. That's for railroad employees. And third, self-employment income, the money you make working for yourself, which you'd figure out on your Schedule SE.
Okay, wages, RRTA, self-employment.
Right. But here's a really key nuance, something that often trips people up. Your Medicare wages and your self-employment income, they get combined when figuring out if you're over the threshold.
Ah, so they add those two together.
Exactly. If you have both, you add them up for that threshold test. But RRTA compensation, that's handled completely differently. It gets compared to the threshold all by itself. It's like it's in its own separate lane for this tax.
Okay, that's a big distinction. Wages and self-employment are a team. RRTA is solo.
Precisely. And one more really important caution. If you have a self-employment loss for the year, you don't count that when figuring this tax. You can't use a loss to reduce your wages for this calculation. It's only about the positive income that pushes you over the threshold.
Okay, good to know. Don't subtract losses.
Yeah.
So that difference between combined income and separate income streams feels really important. Practically speaking then, for us listening, when do we actually need to start thinking about this? When should Form 8959 even be on our radar? There must be clear triggers, right?
Oh, absolutely. There are very specific triggers. This is where you can kind of self-diagnose if this deep dive applies directly to your situation. You'll need to think about filing Form 8959 if any of these things are true for you. First trigger. If your Medicare wages and tips right there in box 5, any single W-2 you received are more than $200,000.
Just from one job?
Yes, from any one employer. If that single W-2 shows over $200 in box 5, that's a trigger. Second trigger, similar idea. If your RRTA compensation, usually in box 14 of a W-2 for railroad folks, is more than $200,000 on any single W-2.
Okay, single source triggers. What about combined?
Right, that's the third trigger. This is where that combining happens. If your total Medicare wages and tips plus your self-employment income, and this is huge for joint filers, you have to include your spouse's income here too if you're married filing jointly. If that total amount is greater than the specific threshold for your filing status, we'll get to those thresholds in a sec.
Okay, so total wages plus total self-employment, maybe including spouses.
Correct. And the fourth trigger is similar, but for RRTA. If your total RRTA compensation and tips, again, including your spouse's if you file jointly, is greater than the threshold for your filing status. So it's about those cumulative amounts, adding things up based on your filing status that can push you over the limit and trigger the need to file.
Okay, thresholds are key then. Let's talk about those magic numbers. What are they for, say, 2024? Because you mentioned these aren't indexed for inflation, right? So they kind of stay put year after year, which is, well, simpler in one way, but means more people might hit them over time.
You're exactly right. They are fixed, which, yeah, is important for long-term planning. For the 2024 tax year, these are the thresholds for the additional Medicare tax. If you're married filing jointly, the threshold is $250,000.
$250K for joint.
Uh-huh. If you're married filing separately, it drops way down to $125,000.
Wow, half, okay.
Yeah, big difference. For single filers, it's $200,000. If you file as head of household, also $200,000. And for a qualifying surviving spouse, that's $200,000 as well.
So mostly 200K, except for joint at 250K and married filing separate at 125K.
Exactly. Those are the critical benchmarks. Your income gets measured against those numbers for this specific tax.
Okay, this is where it gets really interesting for a lot of folks who are employees like me. What about our employers? Are they supposed to be taking this tax out? Or do they just magically know we're going to hit these thresholds based on our filing status and maybe other jobs? This feels like a super common point of confusion.
It absolutely is, and it's a critical question. The answer is yes, but only up to a point. Your employers are responsible for withholding the 7.9% additional Medicare tax. But here's the catch. They only have to start withholding it once the Medicare wages or RRTA compensation they pay you go over $200,000 in that calendar year.
Just what they pay me, not my total income.
Correct. Just what that specific employer pays you. The withholding kicks in starting in the exact pay period where your wages from them cross that $200,000 mark. And it continues for the rest of that calendar year, no matter how many more paychecks you get from them.
Okay, starts at $200 from that one employer.
Right. And here's the really crucial point for you, the listener, especially if you have, say, 2 jobs, or you're married filing jointly. This employer withholding, it happens regardless of your filing status and regardless of any wages or compensation you get from other jobs.
Oh.
Yeah. Your employer only knows what they're paying you. So let's say you earn $150,000 from Job A and $150,000 from Job B. Neither employer will withhold any additional Medicare tax, right? Because neither one paid you over $200,000.
That makes sense from their perspective.
But your total income is $300,000. If you're single, that's way over the $200,000 threshold. So in that case, you will owe the tax even though neither of your employers withheld it. This is a super common way people get a surprise tax bill if they aren't planning ahead.
Okay, that's huge. So if my employer is withholding it because I did cross that $200 K mark with them, I can't just go tell them, hey, stop. I don't think I'll actually owe it when I file jointly.
Right.
They have to take it out.
You nailed it. No, you absolutely cannot ask them to stop. If they're required to withhold it because your wages from them went over $200,000, they legally must do it. They can't comply with a request to stop. It's a requirement for them.
Okay. Mandatory withholding once you hit 200K with that employer.
But, and this is a very important but, there's a silver lining. This connects right back to managing your taxes and not overpaying. Let's say it turns out you don't actually owe the additional Medicare tax when all is said and done. Maybe you filed jointly and your spouse's lower income kept your combined total under the $250K threshold. Or maybe you had some other factors. If your employer did withhold that 0.9%, you absolutely can claim a credit for that withheld amount against your total tax liability when you file.
Ah, okay. So you get it back then.
Exactly. You get it back by correctly filling out Form 8959. That form reconciles what was withheld versus what you actually owe. So it's the key mechanism to reclaim any money that was withheld if you didn't ultimately meet the criteria to owe the tax. It's a really vital part of smart tax management.
That's a massive relief, I bet, for a lot of people. Okay, so we know wages and self-employment income get combined for the threshold test, but RTA stands alone. This really sounds like a potential tripwire for anyone juggling different income streams. Can you dig a bit deeper into why that distinction exists and maybe what are the most common mistakes people make here?
Absolutely. It's definitely a critical area. Understanding how these income types play together or don't play together is fundamental.
Hmm.
So first, just to reiterate, all your wages and any RRTA compensation that are subject to the regular Medicare tax, they're also subject to the additional Medicare tax if they go over your specific threshold amount. For self-employment income, we're looking at your net earnings from self-employment, specifically Schedule SE, Form 1040, Part 1, Line 6. And like we said, ignore any self-employment losses for this calculation. Only positive income counts towards the threshold.
Okay, got it.
Now, here's that concept again, the one that often causes confusion, especially if you've got, say, a day job and a side hustle. The wage self-employment income reduction rule.
Hmm.
If you have both wages from an employer and self-employment income, the threshold amount that applies to your self-employment income actually gets reduced.
Reduced? How?
It's reduced by the total amount of Medicare wages you received. Let's take an example. Say you're single, so your threshold is $200,000. And let's say you have $150,000 in wages from your job. That $150,000 in wages reduces the threshold that applies to your self-employment income. So your self-employment threshold effectively becomes $50,000. That's the original $200,000 minus your $150,000 in wages.
Whoa. Okay.
Yeah.
No.
This reduction can make your self-employment threshold much lower, but it can't go below zero. This is super important because it means your wages can actually cause more of your self-employment income to be subject to this additional tax, even if your self-employment income on its own wouldn't have been enough to trigger it.
That's fascinating. So the W-2 income actively pulls down the trigger point for the 1099 income, essentially.
Yeah.
Wow, that's a huge insight for anyone with that kind of mix. But you mentioned RRTA doesn't do that. Why is railroad income treated so separately? Is it just historical?
Yeah, that's correct. RTA is separate. And the reason it largely comes down to how railroad retirement benefits and taxes are set up. They have their own distinct system separate from Social Security and Medicare for most workers. So there's no equivalent reduction rule for RRTA compensation. It's always compared separately to its own threshold. It doesn't reduce the self-employment threshold. It doesn't get added to wages or self-employment income for one big threshold test. It just stands alone.
Completely separate lane.
Completely separate. And this distinction, it causes a lot of confusion. People sometimes wrongly lump all their income together. Also, just quickly, for non-resident aliens or U.S. citizens living abroad, no special rules here. The standard rules, the standard thresholds apply if their income is subject to Medicare tax and goes over the limits just like anyone else.
Okay. This makes sense, but examples would really hammer it home. Can we walk through some concrete scenarios, like put some real numbers to these rules? That's usually where the light bulb goes on for me and probably for our listeners too.
Definitely. Examples are absolutely the best way to see how these rules work in practice and catch those tricky nuances. Let's run through a few. Okay, example 1, Anne. Anne's single. She's a freelance designer, makes $180,000 in self-employment income, 0 wages. Anne's doing well, right? But she is not liable for the additional Medicare tax, and she doesn't need to file Form 8959.
Why not?
Because her $180,000 is less than the $200,000 threshold for single filers. Simple as that. Income's below the line, no tax due here.
Okay, basic threshold check. Makes sense.
Next, example 2, Bob. Also single. He's got a booming online store, makes $220,000 in self-employment income, 0 wages. Now Bob is liable. His income, $220K, is over the $200K single threshold
Why, how much?
by $20,000.
Right.
$220,000 minus $200,000. So he owes the 0.9% tax on that $20,000. And because he owes it, Bob must file Form 8959 to report and pay that tax. Shows how just crossing the line triggers it for self-employment.
Okay, over the line. Got to file. Clear.
Now for a trickier one, showing that reduction rule. Example 3, Carl. Carl's single. He consults part-time, that's self-employment income of $145,000. He also has a job with $130,000 in wages.
Okay, mixed income.
Exactly. Now his wages, $130K, are under $200K, so his employer didn't withhold any additional Medicare tax. But remember that wage self-employment reduction rule.
Uh-oh, here it comes.
Yep. Carl's $130,000 in wages reduces his self-employment income threshold. The base threshold for single is $200,000. Subtract his wages. $200,000 minus $130,000 equals $70,000. That's his new effective threshold for his self-employment income.
Only 70 cares now. Wow.
Right. So now we compare his actual self-employment income, $145,000, against that reduced threshold of $70,000. The difference is $75,000. $145K. $70K. Carl is liable for the additional Medicare tax on that $75,000 chunk of his self-employment income. So even though no tax was withheld, Carl must file Form 8959. This really shows how wages can silently trigger the tax on self-employment income. It's a big one to watch.
Wow, yeah, Carl's case really drives home that reduction rule. His wages didn't trigger withholding, but they totally changed the game for his self-employment income. That's subtle but powerful.
Exactly. It's about that total picture. Okay, let's do example 4. Don. Don is married, but files married filing separately. He has $150,000 in self-employment income and $200,000 in wages from his job.
Okay, MFS status, that threshold is lower.
Right.
125K.
You got it, $125,000. Now, like Carl, Don's employer didn't withhold because his wages from them didn't exceed $200K. But look at his wages alone, $200,000. That's already way over his $125,000 MFS threshold.
So he owes it just on the wages.
He owes it on $75,000 of his wages, $200,000 minus the $125,000 threshold. So that's part 1. But wait, there's more. That $200,000 in wages also reduces his self-employment income threshold. The MFS threshold is $125K. His wages are $200K. So $125,000 minus $200,000, well, that goes below zero.
So the threshold is 0.
Effectively, yes. The threshold can't be less than 0, which means Don is liable for the additional Medicare tax on all $150,000 of his self-employment income.
Whoa. So he owes on $75K of wages and the full $150 self-employment.
Correct. It's a complex one, showing liability on both income types because of how the wages interact with that lower MFS threshold. Don absolutely must file Form 8959.
Don's situation is like the perfect storm example.
Right.
Shows how critical that filing status and the reduction rule are.
Okay, I think I'm starting to see the patterns.
Good. Let's look at a joint filing scenario. Example 5. Aaron and Frank. Married, filing jointly. Aaron makes $150,000 in wages. Frank makes $175,000 in wages.
Okay, neither one is over $200K individually. Right, so neither of their employers withheld the additional Medicare tax. But for joint filers, what matters?
Their combined income.
Exactly. Their combined wages are $150,000 plus $175,000, which equals $325,000. The threshold for married filing jointly is $250,000. Their $325K is clearly over that.
By $75,000.
Precisely. $325K, $250K. So Aaron and Frank are liable for the additional Medicare tax on that $75,000 of their combined wages. They must file Form 8959. This really highlights why joint filers need to look at the household total, not just individual paychecks.
Makes sense. That $250K threshold seems high, but 2 decent incomes can definitely cross it.
Definitely. Okay, now let's bring in RRTA. Example 6. George and Helen. Married filing jointly. George has $190,000 in wages. Helen has $150,000 in RRTA compensation.
Okay, again, neither is over $200K individually, so no withholding. Joint threshold is $250K. Do they add them?
Remember the rule.
Yeah. RRTA is separate.
Exactly. George and Helen do not combine wages and RRTA compensation for the threshold test. George's wages, $190K, are below the $250K joint threshold. Helen's RRTA compensation, $150K, is also below the $250K joint threshold. Since neither income type, looked at separately, crosses the joint threshold, they are not liable. They don't need to file Form 8959.
Wow. That separate treatment makes a huge difference for them. If they had combined it, they would have been over.
Absolutely. It's a critical distinction. One last one to really cement this. Example 7. Ishmael and Judy, married, filing jointly. Ishmael has $160,000 in self-employment income. Judy has $140,000 in RRTA compensation. Judy's employer didn't withhold, as she's under $200. Now, does Judy's RRTA income reduce Ishmael's self-employment threshold?
No, because RRTA stays separate.
Oh, yeah.
It doesn't interact with the self-employment threshold reduction rule.
Perfect. You got it. The RRTA income does not reduce the self-employment threshold. So we look at them separately against the $250,000 joint threshold. Ishmael's self-employment, $160K, is below $250K. Judy's RRTA, $140K, is also below $250K. Therefore, Ishmael and Judy are not liable. No Form 8959 needed. These examples really hammer home how crucial it is to know which incomes combine and which stay separate.
Wow, those examples were incredibly helpful. Seriously, seeing the numbers and the different scenarios play out makes it so much clearer. Yeah, it shows how easy it would be to get this wrong if you didn't know those specific rules.
Yeah.
Okay, so we've thoroughly covered the if and why, who owes this, and based on what income. Now let's get super practical. Let's dive into the how. How do we actually fill out this Form 8959? Can you walk us through it, like line by line? This is where we connect all that understanding to the actual tax form.
Excellent idea. Yes. Let's walk through the form itself. It might look a bit daunting at first, but it's logical once you break it down. It's divided into parts based on income type. So right at the top, you've got the general information, pretty standard stuff. Your name, or names if filing jointly, and your Social Security number. Just make sure these match exactly what's on your main Form 1040 or other return. If you're filing jointly, use the first SSN listed on your main return. Helps everything process smoothly.
Okay, basic info first.
Got it. Then we hit Part I, additional Medicare tax on Medicare wages. Now, if you didn't have any Medicare wages, maybe you're purely self-employed, you just skip this whole section. But if you did have wages, this is where you start. Line 1 asks for your total Medicare wages and tips. This number comes straight from Box 5 of your W-2s. If you had multiple jobs, multiple W-2s, you just add up all the Box 5 amounts, simple addition. And if you're filing jointly, remember to add your spouse's Box 5 amounts too. Get that total combined wage figure.
Okay, line 1 equals total Box 5 from all W-2s.
Exactly. Then line 2 is for unreported tips. This connects to another form, Form 41311, Social Security and Medicare tax on unreported tip income.
Yeah.
If you got cash tips you didn't report to your employer or they didn't collect enough tax on them, the amount from line 6 of Form 4137 goes here on line 2. Include your spouses too, if applicable. And just a quick heads up here. The IRS can hit you with a pretty stiff penalty, 50% on the Social Security and Medicare taxes owed on tips you should have reported but didn't.
Ouch, 50%.
Yeah. You can potentially avoid it if you show reasonable cause, not willful neglect, usually with a statement attached to your return, but definitely something to be careful about with tips.
Good warning. Okay, what's line 3?
Line 3 is for wages reported on Form 899 uncollected Social Security and Medicare tax on wages. This is less common. It's usually for situations where maybe your employer misclassified you as a contractor, but you were really an employee, or for some other reason they didn't collect the right Medicare taxes. The amount from line 6 of that form goes here. Includes spouses if joint.
Okay, seems like in each case, but good to know where it fits.
Right. Then the form has you do a few calculations on lines 4, 5, and 6, basically subtracting the threshold for your filing status from your total wages. And that leads you to line 7. This is where you calculate the actual tax on the wages. You take the amount from line 6, that's the wages over the threshold, and multiply it by 0.9% or 0.009. That's your additional Medicare tax specifically from wages.
Okay, multiply the excess wages by 0.0009. Makes sense.
Next up is Part 2, additional Medicare tax on self-employment income. Again, if you had no self-employment income, you just skip this part entirely, move on to Part 3.
Easy skip if it doesn't apply.
Yep. But if you do have self-employment income, you start with line 8. Here, you put your self-employment income straight from your Schedule SE, Form 1040, Part 1, line 6. If you run multiple businesses and file multiple Schedule SEs, just combine the line 6 amounts from all of them. And remember, no losses here, only positive income.
Line 8 equals Schedule SE, line 6 income.
Correct. Now, the next few lines, lines 9 through 11, this is where the form itself does that crucial calculation we talked about, the wage self-employment income reduction rule. These lines guide you to figure out your reduced threshold for self-employment income, factoring in the wages you reported back in Part 1.
Ah, so the form walks you through that tricky reduction step.
It does. It leads you to line 12. Line 12 shows the amount of your self-employment income that is actually taxable for the additional Medicare tax after applying that potentially reduced threshold. This is a really key number. Then line 13 is straightforward again. You take that taxable amount from line 12 and multiply it by 0.9%, 0.009. That's the additional Medicare tax due on your self-employment earnings.
Can we use that Kathleen and Liam example here to see how it looks on the form?
Perfect idea. So Kathleen and Liam married filing jointly. Kathleen had $130 K in wages. Liam had $140 in self-employment income. Kathleen's $130 K wages would flow through Part 1. Liam's $140 K self-employment income goes on line 8 in Part 2. Their joint threshold is $250 K. Lines 9 through 11 would calculate the reduction. $250 threshold minus Kathleen's $130 wages equals a reduced threshold of $120 K for Liam's income. So on line 12, the taxable self-employment income would be $20,000. That's Liam's $140 K minus the reduced $120 K threshold. Then on line 13, the tax would be $180. That's the $20,000 from line 12 times 0.0009. See how the form mechanically applies that rule.
Right. Seeing it tied to the specific lines makes it much clearer how that reduction actually gets calculated. Great example. Go what's next, Part 3.
Right. Part 3, additional Medicare tax on Railroad Retirement Tax Act, RRTA compensation. Skip it if it doesn't apply to you. This is purely for railroad folks.
Okay, RRTA section.
If it does apply, line 14 is where you enter your total RRTA compensation and tips, usually found in box 14 of the W-2 for railroad employees. Add up all W-2s if you have more than one. Also, employee representatives subject to RRTA would include their total compensation subject to Tier 1 Medicare tax from Form CT2, line 2. Similar to the other parts, you'll eventually get to line 17. Here you calculate the tax by multiplying the RRTA compensation subject to the tax from line 16 by 0.9%, 0.0009.
Okay, same 0.9% calculation, just on the RTA amount over the threshold.
Exactly. Now, after you've potentially calculated tax in parts 1, 2, and 3, you get to part 4, total additional Medicare tax. This brings it all home. Line 18 is just the grand total. You add up the tax amounts you calculated on line 7, wages, line 13, self-employment, and line 17, RTA. This final sum on line 18 is then carried over to your main tax return. It goes on to Schedule 2, Form 1040, line 11. Or if you file Form 1040 SS, it's Part 1, line 5.
So line 18 is the total AMT you owe, and it flows back to the main 1040.
Precisely. It becomes part of your overall tax liability. And finally, Part V, withholding reconciliation. This section is super important. Its job is to figure out how much additional Medicare tax was already withheld by your employer. It's especially crucial if you think you didn't owe the tax in the end, but your employer withheld some anyway. This is where you reconcile that and set yourself up for a credit or refund.
The getting it back part if too much was taken.
Exactly. You'd skip this part only if you had 0 Medicare wages and 0 RRTA compensation all year. So, line 19 asks for the total Medicare tax withheld. This comes from Box 6 of your W-2s. Add up all the Box 6 amounts. Now remember, Box 6 includes both the regular 1.45% Medicare tax and any 0.9% additional Medicare tax withholding. The IRS combines them in that box.
Okay, Box 6 is the combined Medicare withholding.
Right. You also include on line 19 any uncollected Medicare tax on tips shown in Box 12, Code B of your W-2, and uncollected tax on group term life insurance over $50, Box 12, Code N. But do not include uncollected RRTA Medicare tax here.
Got it. Mostly Box 6 plus those specific Box 12 codes.
Then you jump down to line 23. This asks for the additional Medicare tax specifically withheld if your employer reported it separately. This would be in Box 14 of your W-2s. Add up all Box 14 amounts. Railroad employee representatives would also include the total AMT paid from Form CT2, line 3 here.
Okay, so Box 6 has the total. Box 14 might specifically break out the AMT part. You report both in different places here.
Well, line 19 captures the total from Box 6, and subsequent lines help isolate the regular Medicare portion to figure out the AMT withholding. Line 23 is for amounts specifically designated as AMT withholding, usually from Box 14 or Form CT2. The form uses these inputs to reconcile everything. The final result of this reconciliation, the total withholding attributable to AMT calculated on line 24, gets included with your regular federal income tax withholding on your main return. So on Form 1040, 1040 SR, or 1040 NR, it gets added into the amount on line 25C. If you file Form 1040 SS, it goes to Part 1, line 11A.
Okay, so the withheld AMT effectively counts toward your total tax payments for the year.
Correct. And the absolute last step, don't forget to actually attach the completed Form 8959 to your main tax return, whether it's 1040, 1040 SR, 1040 NR, or 1040 SS. Staple it on.
Don't just fill it out, make sure it gets filed.
That
was incredibly detailed, thank you. Walking through it line by line really demystifies it. It feels manageable now.
Yeah.
So we get the mechanics, we know how to report it. What does this mean going forward, like for next year or even planning the rest of this year? Can we do stuff during the year to manage this liability so we're not just reacting at tax time? It really feels like avoiding surprises is the name of the game here, maybe saving some money on penalties too.
That's exactly the right way to think about it. It raises that crucial question.
Yeah.
How do you proactively manage this potential AMT liability? And, just as importantly, steer clear of underpayment penalties. The whole idea is smart tax management throughout the year, not just that mad dash in April. It's about keeping more of your money by avoiding penalties and maybe not overpaying unnecessarily through the year.
Proactive, not reactive. I like it.
So step 1 is really anticipating if you'll even have a liability. Look at your expected wages, any RRTA income, any self-employment income for the year. Will your total income likely cross that threshold for your filing status? Remember, your employer only starts withholding based on their payments hitting $200. They don't know about your other income or your spouse's income or your filing status, so it's very possible, even likely for many high earners, that you'll be under withheld for the additional Medicare tax, even if your employer is taking some out.
Right, because they don't see the whole picture.
Exactly. So if you look ahead and see a potential gap, you think you'll owe more AMT than what's being withheld, you need to take action. One major tool is adjusting your income tax withholding with your employer. You do this by giving them a new Form W-4, the Employee's Withholding Certificate. On that form, you can specifically request that they withhold an additional amount of income tax from each paycheck.
Ah, okay, so I can just tell them to take out extra.
You can. But here's the important part. That extra withholding applies to your total tax liability for the year. That includes your regular income tax and any additional Medicare tax you might owe. You can't specifically earmark that extra withholding only for the additional Medicare tax. It just goes into the general pot of federal withholding.
So it covers everything, not just AMT.
Correct. But the Form W-4 itself has worksheets and online tools the IRS provides that help you estimate how much extra to withhold based on your total expected income, your filing status, dependents, other deductions, everything. It helps you get that total withholding number right to cover all your taxes, including the AMT. It really puts you in control.
Okay, adjusting the W-4 is one option. What else? Especially for self-employed folks.
Right. For people with significant self-employment income or maybe multiple jobs where no single employer hits the $200 K mark, the other key tool is making estimated tax payments. If you figure your withholding won't cover your expected AMT liability, plus all your other taxes, you probably need to make estimated payments. Usually these are paid quarterly throughout the year.
Quarterly payments. Okay.
And just like with the extra W-4 withholding, these estimated payments cover all your taxes, income tax, self-employment tax, which includes regular Social Security and Medicare, and any additional Medicare tax. You can't designate them just for AMT. When you're figuring out if you need to make estimated payments and how much, you look at your total expected tax bill for the year versus what you expect to have withheld. The general goal is to pay in, through withholding and estimated payments combined, at least 90% of the tax you'll owe for the current year, or 100% of the tax you owed for the prior year, whichever is smaller. There's a higher 110% rule for the prior year if your income is very high, over 150K AGI. Meeting one of those safe harbors helps you avoid penalties.
90% of current or 100% of prior year.
Got it. Now, for married couples filing jointly, this planning is extra important. If you expect your combined income to go over that $250,000 threshold, you really need to consider either asking for extra withholding via W-4s or making those estimated payments. That joint threshold often catches couples by surprise, especially if neither spouse hits $200Ks individually with their employer. Oh, and a quick note. If you live in a community property state and you're thinking about filing married filing separately, check out IRS Publication 555. The rules for how withholding is allocated can be different in those states.
Good tip for community property states. So when might you not need to worry about estimated payments? Is there a minimum threshold?
Generally, yes. If you expect that when you file your return, you'll either get a refund or owe less than $1,000 in tax, you usually don't need to make estimated payments.
Under $1,000, probably okay.
Probably. But if you think you'll owe $1,000 or more after subtracting your withholding and any refundable credits, then you definitely need to look into it. The best resources are Form 1040-ES, Estimated Tax for Individuals, or 1040-ES-NR for non-resident aliens, and IRS Publication 505, Tax Withholding and Estimated Tax. They have detailed worksheets to figure out if you need to pay, how much, and the quarterly deadlines.
Okay, 1040-ES and Pub 505 for the details.
And one final, very serious warning. The estimated tax penalty. You can absolutely get hit with a penalty if you owe additional Medicare tax or any significant tax, and you just wait to pay it all when you file your return in April. The IRS system is pay-as-you-go. They expect you to pay your taxes roughly as you earn the income throughout the year.
Pay-as-you-go.
If you don't pay enough through withholding or timely estimated payments, you might owe a penalty. You figure this out using Form 2210, Underpayment of Estimated Tax by Individuals, Estates, and Trusts, or Form 2210F for farmers fishers. So this proactive planning we're talking about, it's not just for peace of mind. It's about intelligent tax management, avoiding those extra penalty costs, and keeping more of your money working for you, not sitting with the IRS unnecessarily, or worse, paying penalties on top.
That's incredibly helpful. Really drives home that point. Proactive planning, knowing these thresholds, understanding the rules, it's absolutely key. Not just to avoid surprises, but to avoid those penalties too. It's not about dodging the tax, but just managing it smartly, efficiently, so you're not caught off guard or paying more than you need to through penalties.
Exactly. That's the core message. Understanding Form 8959 and the additional Medicare tax, it's not just about compliance, not just another form to fill out. It really is about intelligent tax management. It's about knowing your obligations, looking ahead to anticipate your liability, and then taking those concrete steps, adjusting withholding, making estimated payments to make sure you're neither underpaying and risking penalties, nor overpaying and letting the government hold your cash interest-free. It puts you firmly in the driver's seat.
Couldn't have said it better. Okay, that brings us to the end of our deep dive into the additional Medicare tax in Form 8959. So for you listening, what really stands out? How does knowing about these specific high-income thresholds, and especially those rules about combined versus separate income, how might that change your tax planning for the rest of this year or for next year? Here's a thought to maybe chew on. How might anticipating these specific tax triggers earlier in the year change your financial habits? Maybe even conversations you have with your employer about your W-4 withholding. And remember, if you want to go even deeper, the IRS has tons of great resources. Check out publications like Pub 15, Employer's Tax Guide, Pub 505, Withholding and Estimated Tax, Pub 531, Reporting Tip Income, and Pub 555, Community Property, all free on irs.gov. You can also find specific FAQs on this tax at irs.gov ADMT Facts and info focused on Form 8959 itself at irs.gov Form 89599. Thank you so much for joining us on this deep dive. Until next time, keep learning, keep asking questions, and stay well informed.